Hello, everybody. This is the second of a two-part series on inflation. This will cover inflation dynamics. My name is David Gully. I'm from Bentley University. Please check out our YouTube channel, Bentley University EC391, for lots of videos on monetary policy and macroeconomics. So our agenda today, remember in part one, we have covered the measurement of inflation and inflation expectations in some detail. And so in part two, we're going to look at, in general, what are known as inflation dynamics. So the first thing we'll take a look at is, well, why was pre-pandemic inflation relatively low? Then we'll take a look at, well, why post-pandemic inflation has increased very dramatically. And then finally, we'll take a look at another series of interesting questions. So let's look at a couple of visuals first. First, we have the CPI inflation rate. Excuse me, this is the most common measure of inflation that you see reported in the news. And you can see here that pre-pandemic, the CPI inflation rate, both the core in the red and the headline in blue, were relatively low and stable, well below actually the Fed's 2% inflation objective. But you can see post-pandemic, the very dramatic increase in inflation, and only recently in the last 3 or 4 months has it started to decline. Looking now at PCE inflation, this is a broader measure of inflation. This is the inflation rate that the Fed pays more attention to. Again, the headline figure is in blue, and the solid red line is the core, excluding food and energy. Same general pattern, right around the Fed's 2% inflation objective, somewhat below it. Oops, technical difficulties here, apologize. Oh, there we go. Generally below the Fed's 2% inflation target, but then same pattern with the CPI, relatively dramatic increase. But notice that the level of the PCE inflation rate is somewhat lower than the CPI, and that's a standard outcome of the CPI versus the PCE inflation rates. And so let's think about some of the reasons why, compared to pre-pandemic, the inflation rate was so low. Well, to have something like that, it takes a number of factors generally. So first, there was restrained monetary and fiscal policy, meaning monetary policy and fiscal policy were not dramatically expansionary relative to the supply side of the economy. So if you're expanding demand very fast relative to supply, that will generate inflation. So at least with policy, that was not happening. And then second, we had demographic factors. So for example, we have or had a relatively quickly growing labor force compared to now, for example, especially in other parts of the world like China. And so that large labor force growth allows for lower costs, higher levels of production, and in general helps push inflation down. Likewise, we had relatively strong productivity growth. Productivity is output per person or output per hour. If that's growing relatively quickly, that effectively is an increase in aggregate supply, and that helps keep inflation down. Then we had globalization. Globalization acts as a competitive force that helps keep down the level of especially the prices of goods. I do have some visuals on this here shortly. And so as a consequence of this high level of competition from various countries, that helps keep inflation, especially in goods, relatively restrained. We also had low expected inflation. As we'll talk about later, low expected inflation tends to help keep actual inflation also low. And then finally, some of it was just blind luck. Nothing terrible happened in terms of generating a relatively high inflationary shock, like, for example, the OPEC shock of the 1970s. And I should point out that the relatively restrained inflation rate was not a unique feature to the United States. A number of other, especially developed countries, experienced this same phenomenon. And so let's think about, well, why the dramatic change pre versus post-pandemic? So first, on the supply side, we saw a number of supply side bottlenecks, shipping delays, things like this. We saw shutdowns in China, which exacerbated the ability of China to supply particular goods to the US and other countries. We saw relatively dramatic increases in energy prices, especially, for example, post-Russian invasion of Ukraine, and then scarce labor. And so, related to China and related to the US and other countries, there was a decline in the supply of labor. We've got some visuals on that in a second. All of those factors work to reduce or constrain aggregate supply, which will in turn work to push up inflation. Likewise, on the demand side, we had very expansionary monetary policy. We had the reduction of the federal funds rate down to the zero lower bound. We had quantitative easing, and we had forward guidance, all of which act as expansionary policy. We had expansionary fiscal policy, large increases in government spending. For example, most families in the US received multiple rounds of stimulus checks. There was also an issue of the speed at which aggregate demand rose. Again, I've got a visual here on this in just a few minutes, but the idea is a really fast increase in aggregate demand acts as a constraint against aggregate supply, and that helps push up inflation. And then finally, we had a change in the composition of aggregate demand. It went initially relatively away from services and relatively toward goods. And the goods producing industry was relatively constrained at meeting that demand. So again, that helps exacerbate any increase in inflation. So the basic idea here is at the very beginning of the pandemic, aggregate demand and short run supply fell very dramatically and very quickly. However, on the upside, there's a symmetry problem. It's relatively easy for aggregate demand to bounce back quickly, but it's much, much harder for short-run aggregate supply to turn back on. It's easy to turn short-run supply off. It's much more difficult and slow to turn it back on. And remember, one of the things that is taught in basic principles of micro courses is that over short periods of time, supply is going to be relatively inelastic. In other words, it's very difficult in a very short period of time for firms to increase output and production to meet an increase in demand. So let's look at some examples here. So let's take a look at a demand shock from the switch to goods versus services. And so you can see here in goods and in services, at the very beginning of the pandemic in the US, there was a decline in spending on both. But note the decline in services was far more dramatic. But then on the expansionary side, once the economy started to open up, and once government stimulus started to happen, and once monetary policy started to work, there was a gigantic increase in the demand for goods. This is automobiles, televisions, all sorts of things. It was very difficult for suppliers to meet that demand, and so as a consequence, prices were pushed up. The bounce back, as you can see on the right, in services was relatively slower. But recently, there's been a switch away from goods and towards services spending. And so services spending has started to accelerate, while goods inflation has started to decline, as we documented back in part 1. So you can sort of see this in this visual here in a recent paper. And so what the authors have done is they've broken down inflation in terms of looking at the impact of durable goods, blue, non-durables, sort of an orangey yellow, and services, kind of gray. And so you can see with the blue here, for a number of years pre-pandemic, the prices of durable goods were actually declining on average. And that's partly due to the globalization I was talking about earlier, in that high levels of competition combined with productivity gains helps push prices of durable goods downward. But as you can see, post-pandemic, you can see the blue here, there's been a dramatic change in the level of inflation of goods, but that's already starting to slow down. And notice here is that some of the increase also is now being reflected in services. So here's another example of an aggregate demand shock. This is from fiscal policy. And so DeSawyers and some co-authors looked at what they call excess inflation relative to what would have been otherwise the case. And they tried to attribute this to various components. And the way you interpret this is that, roughly speaking, about 2.5% of the recent excess inflation is correlated with expansionary fiscal policy. And the way you interpret those other bars is that our Canadian neighbors experienced almost as much of an increase in actual inflation, because of course the US and Canada maintain very close ties. Even still, we've seen This is emerging market economies, some spillover inflation, along with our trading partners in the UK and Germany. But unsurprisingly, the biggest effect was directly in the US and on our nearest trading partner, Canada. An example of a short-run agri-supply shock, oil prices. So you can see the very dramatic spike post-pandemic. So basically every good and service requires some level of energy to produce, some small, some large. But in the aggregate, this acts as a decrease in short-run agri-supply. This helps push up the overall level of inflation. And you can see, however, oil prices and energy prices in general have started to notably decline. Supply chains. The Federal Reserve Bank of New York maintains what they refer to as a global supply chain pressure index. And this includes all kinds of measures, including, for example, prices of shipping goods via container, shipping goods via rail, shipping goods via truck, and so forth, shipping delays, and a number of other variables. And the way you interpret this is that zero means, or a value of zero would mean it's exactly at its average level over a period of time. Deviations above zero or below zero, above zero means things are notably worse, for example. Below zero, things are notably better. And so you can see here that post-pandemic, the supply chain index was multiple standard deviations away from its typical value. And as a consequence, that's a good visual of the difficulty of supply chains meeting demand to produce particular types of goods. But notice that in recent months, while we're not quite back to normal or quite back to average, it's the problems have declined very, very notably. Now, here's the thinking in terms of looking at perhaps a long-run agri-supply shock. This is from Faberman et al., again, in a recent paper. So what's been heavily documented in the literature is the decline in the labor force participation rate. The labor force participation rate is the percent of the population that's either working or looking for work. And so that's the orange line right here. And you can see, again, the notable decline and then only a partial bounce back in the labor force participation rate post-pandemic. Even more dramatically, however, there's been a decline in the hours worked, or what they refer to as potential work hours. And so what this means is that even existing employees, existing workers, are working fewer hours. And that's not due to a lack of demand in terms of no work for these people. That's to the contrary. There's very high demand for labor at the moment. And the fact that hours worked have declined suggests that this is more a choice on the part of workers. And so as a consequence, this may act like a decline in long-run agri-supply if this continues on. And so you can see here kind of a summary in terms of looking at the sources of the change in the inflation rate. And so what several authors did is they attempted to disassemble or decompose the portion of inflation that's due to demand and the portion of inflation that's due to supply. And so the conclusion here is that a majority, roughly 2/3 or thereabouts, is due to changes in aggregate demand, and roughly 1/3 or so is due to changes in aggregate supply. So let's take a look at some other interesting questions here in terms of a wage price spiral. Why inflation was more persistent than was initially anticipated, because we recall, for example, that even into early 2022, the Fed was on team transitory. Is the Fed behind the curve? In other words, did it start tightening policy too late? And then what's the cost of lowering inflation in terms of, well, if we want to reduce inflation by, say, the use of monetary policy, by how much do we have to pay for that in terms of, say, a higher unemployment rate? And then finally, what sorts of factors might impact inflation going forward? So let's look at the wage price spiral first. So here's the idea. So suppose that inflation expectations increase on the part of workers. Workers expecting higher inflation will therefore demand higher nominal wages to compensate for that higher inflation. This causes firms to experience higher costs. Those higher costs can be pushed on in terms of higher prices to final goods and services. And the idea is that this process could keep continuing spiraling, that's where you get the name, upward. And so the visual on this would be, this would shift the short-run aggregate supply curve to the left, and that would work to push up actual inflation. And there's a good argument here is that for many years, or a number of years at least, workers probably weren't paying too much attention to inflation simply because it was so low. That's the idea of what's called rational inattention. Workers were rationally not paying much attention simply because it wasn't worth the bother of doing so. Well, not surprisingly, given the large increase in inflation that we've observed, workers, everybody in general, of course, is paying now very close attention. And as a result, those higher inflation expectations could be being passed on in the form of higher wages. Well, at the moment, most nominal wages are not keeping up with inflation. This is now as of 2022. If real wages are now declining, that's going to help restrain inflation over time. It's hard for inflation to continue increasing when real wages or real income is declining. And what's interesting here is that pre-pandemic, there wasn't much of a correlation of expected inflation with nominal wage growth. So here we have a visual, and this is from Jorda et al. In a very recent paper. And so what they tried to do is they tried to decompose nominal wage growth into various components. And so what we want to pay attention to here is the size of the red column, and that's the correlation of, or the proportion of wage growth, nominal wage growth, that can be associated with inflation expectations. And so you can see to the left here, pre-pandemic, is that the height of the little red bar there is very tiny. In other words, other factors were much more important in driving nominal wage growth. But notice that post-pandemic, the red bars are much larger. And so the idea is that the correlation with nominal wage growth, which you can notice now is much higher post-pandemic, is substantially correlated with changes in inflation expectations. And so there is some evidence that workers and firms, of course, are now paying very careful attention to expected inflation when thinking about the correct wages. But as I've noted, real compensation still on net, especially in 2022, hasn't kept up. So for example, this is what's known as the employment cost index. This includes not just wages and salaries, but also benefits and other side compensation. And so you can see that going into mid toward late 2022, it's rising at a 5% annual rate, and that's notably behind the most recent inflation rate, even measured by the personal consumption expenditures. And so what we want to turn to now is to think about, well, why was the increase in inflation more long-lasting than the Fed anticipated? The idea, of course, being that the Fed was effectively deemed transitory as late as early 2022. And so there's probably a couple of things here that were going on. So first, they very likely underestimated the persistence of the various supply side problems that we mentioned earlier. It took longer for firms to figure out how to reorganize their supply chains if they're a good producer, to figure out, well, how can we produce the same goods as before with a different type of supply chains, different suppliers, and so forth. And they also likely underestimated the bounce back in terms of aggregate demand post-COVID. Everybody running out and buying cars and televisions and washing machines and things like this. And to be fair to the Fed, it's extraordinarily difficult to make forecasts coming out of a once-in-a-lifetime pandemic, because all forecasting models rely on the past being a relatively decent guide of the future. And their statistical models simply had not experienced, in terms of data, the scale of a pandemic here. And so as a consequence, the models were being asked to do things they really didn't have any experience at, or in other words, they weren't very good at. And of course, the Russian invasion of Ukraine caused a number of inflationary side effects, and those, of course, would be very, very difficult for the Fed or any other institution to forecast. And so this sort of brings up the following question. Well, is the Fed behind the curve? Because you would think that, well, wouldn't it have been better for the Fed to begin tightening policy, not waiting for inflation to happen, but perhaps in advance of inflation to head it off? And so the question we want to investigate here is, well, what would have happened if the Fed had, in fact, tightened policy sooner than it did beginning, for example, in March 2022, when it began increasing the federal funds rate from the zero lower bound? So Barnashon and Mesters did an interesting little thought experiment here. They created a model of the economy, and then they simulated what would have happened if the Fed, instead of waiting until March 2022, had started increasing the federal funds rate roughly a year earlier. And again, it would seem like that would be a better thing to do, because that would not have put the Fed behind the curve. So Barnashon gave a very neat summary of that paper. And again, this is a simulation. And so the solid red line here, this is the actual rate of inflation that we observed. Again, this is so here's when their time period ends. And then the dotted line, that's the simulated level of inflation had the Fed begin its policy tightening roughly a year earlier. And you can see that by early 2022, the difference between the solid red line and the dotted line there is just about a percentage point or so. And so the Fed would have been able to reduce inflation, again, roughly speaking, by about a percentage point had it began tightening a year earlier. But one of the difficulties is, well, suppose that they had done that, the Fed had tightened earlier. One possibility is that had they done so, this would have pushed up the unemployment rate. And in their simulation, now again, this is a key point here, is the simulation. So it's only an estimate. So we don't want to put too much into it. But notice that the unemployment rate, they're counterfactual, meaning suppose the Fed had tightened versus the unemployment rate that we actually observed in early 2022 was almost 1.5 point higher. So you got a 1% percentage point decrease in inflation with about a 1.5% percentage point increase in the unemployment rate. That's a relatively high cost. And so it's not clear then, in other words, there would have been, or it would have been worth it for the Fed to tighten sooner, because it's possible, again, it's possible based on their simulation, that the cost would have been quite high. So this brings up yet a following question, is according to the Barnashon results previously, there's a reasonable cost of lowering inflation in terms of, if you want to reduce aggregate demand, that will in fact lower inflation, but it might do so at the cost of relatively higher unemployment. And so a very wide-ranging discussion has come up in the economics profession, thinking about, well, okay, in terms of the Fed's current policy of pursuing a tighter policy, how much will the cost be measured in any increases in the unemployment rate? And so Larry Summers is one of the most vocal proponents that it will be costly to bring down inflation in terms of a relatively higher unemployment rate. Chris Waller, who is on the Fed Board of Governors, so he's perhaps slightly biased, of course, is suggesting it perhaps might not be that costly. It might increase the unemployment rate a little bit, but that the resulting large decrease in the inflation rate, if the Fed can be successful, that will be well worth it. Now, another approach that we can take here is that there's a well-known level of literature in the macroeconomics, in that the more likely a policy is anticipated or expected by the public, the smaller the impact will be on the unemployment rate, and the relatively larger impact will be on the inflation rate. And the intuition is pretty good here. If the public at large, this is households and consumers and firms, know that the central bank, the Fed, is tightening policy, then this gives them maneuvering room to prepare and anticipate for this tightening of policy. And so therefore, if they're not going to be caught off guard, or they're less likely to be caught off guard, and as a result, what happens then is that relatively speaking, when aggregate demand falls, most of the impact is going to be on lowering inflation, which of course is what the central bank wants and what the Fed wants, and a relatively smaller impact on the unemployment rate. And so if that's the case, then perhaps, again, with fingers crossed, of course, there's a chance that the Fed can reduce inflation without increasing the unemployment rate particularly dramatically. Now, there's one really notable cautionary tale here, is that in past situations, for example, the 1970s, when inflation rate was relatively high, is that yes, inflation was brought down successfully, but there was a very high cost in terms of increasing the unemployment rate. So they haven't been able to ever reduce an inflation rate this high without increasing unemployment, at least pretty dramatically. So we have to be careful here. Now, one of the issues related to this is the very famous long and variable lag problem. So a change in policy today, change in monetary policy today, impacts the real economy months or perhaps even years later. And so this lag is not predictable. It changes over time. Certain parts of the economy are impacted more quickly. Some parts of the economy are impacted more slowly. And so since March, when the Fed started raising the federal funds rate, for example, right now, here we are, this is December 2022, we're only about 9 months out from the Fed's initial policy response of raising the federal funds rate. That isn't that long of a time period for a change in monetary policy like that to have an impact on the real economy. And so what might happen there, and this is what the Fed is quite worried about, and Jerome Powell mentioned this very frequently in his press conference, is there's concern that they could either tighten too much, slow the economy down too much, or they could under-tighten, or in other words, let inflation persist, and that persistent inflation could be relatively costly. But there's hopefully good reason to think that perhaps the policy lags might not be as long as they were in the 1970s. Compared to, for example, the 1970s, the Fed is now very vocal. It communicates its policy actions, its policy intentions, its policy goals, and so forth, much more widely than it used to. In the days of old, the Fed said nothing. It made policy decisions effectively in secret, and the public at large was left to sort of discern or figure out what the Fed was up to. This made it more likely that the policy changes were unanticipated, and that therefore they would take a longer time to impact the economy. And so now, with policy being anticipated, it's much more likely that the reactions in both the financial markets and the real economy are going to happen more quickly. And specifically, in his November 2nd, 2022 press conference, Jerome Powell noted that financial conditions had tightened dramatically in advance of the Fed's initial March 2022 rate increase. For example, mortgage rates increased, general market level interest rates rose, equity prices fall, and so forth. But we don't want to over dramatize this too much. The US economy is exceptionally large. It's the world's largest single economy. It takes a long time for whatever direction it's moving in, accelerating inflation, for example, to slow that down, even if the policy is anticipated fully and correctly. And so now let's take a look at what factors might impact inflation going forward. So remember, pre-pandemic, inflation was relatively low, sometimes below the Fed's 2% objective. So let's first look at fiscal policy. Relative to the pandemic, fiscal policy is now substantially less expansionary. So there was some concern, for example, that the student loan forgiveness would act as expansionary monetary policy, effectively make everybody tens of thousands of dollars richer who had student loans. There's a chance, for example, this might not happen. It's tied up in court at the moment. There was also passed the Inflation Reduction Act, and alas, that probably isn't going to have very much of an impact on inflation one way or the other. It'd be very difficult to find the impact probably around any random noise, random variations that we observe in inflation. Monetary policy, likewise, is not nearly as expansionary, and in fact has now moved into restrictive mode, not just in the US, but around the world. And so you have lots of central banks, especially in developed countries, now pursuing substantially tighter policies. And what's important to note here is that now you have central banks pursuing restrictive policies. It's extraordinarily difficult to have any sort of sustained high rate of inflation in the face of restrictive monetary policy. Well, what about expected inflation? So Jerome Powell and the Fed care very much about expected inflation. Does it remain anchored? If it does, that then helps actual inflation to prevent it from becoming too accelerated. I've got a visual on the next graph here. As we've noted earlier here, supply chain issues are generally much better. They're not perfect. They're not back to normal by any stretch, but they're much, much better compared to the worst of the pandemic. There's a higher value of the US dollar, so the US dollar has gained relative to other currencies, though this is starting to dissipate a little bit. But the idea is that a higher value of the US dollar acts as a restraint on inflation. It makes foreign goods and services cheaper, and those cheaper foreign goods and services act as competition to domestic goods and services, helping lower inflation. Some components of the very high inflation rate, especially early in the pandemic, have already reversed themselves. Consider, for example, one of the things that got the most attention, or a lot of attention, were new and used car prices. Those have already reversed and reversed pretty dramatically. There are other factors that are likely to reverse in the near future. For example, rent increases had started to have a notable impact on inflation, and what are known as owner imputed rents. In other words, what would it cost an owner of a house to rent their own house? That's what's included in inflation measures, not the actual increase in the price of a house, for example. Those notably increased, but now we're starting to see downward pressure on those. And over time, that downward pressure is going to work to pretty notably reduce inflation measures because of the relatively high weight that housing is given in various measures of inflation. So here's a measure of, or here's looking at actual and a measure of expected inflation. And so the solid red line, that's the CPI, going all the way back to the 1970s. And then the blue line is the University of Michigan Survey of Inflation Expectations. This measures households' expectations of inflation 12 months into the future. And so you can see that over the period here, this is a very long period, these two generally move along relatively together. But however, there are divergences. So in the early 1980s, for example, beginning of the financial crisis, for a decent time during the mid-2010s, and then most recently post-pandemic. But notice they've always tended to converge. And Jim Bullard, president of St. Louis Fed, has noted this in that if there's a large divergence between expected and actual inflation, forces generally come into play to converge those back together, either in the reduction of actual inflation, which seems to be happening, or the increase in expected inflation to correspond to the higher actual inflation. And so it seems to be happening, again, at least so far anyways, is that actual inflation seems to be starting now to converge back down toward expected inflation. And one other note here to have a look at in terms of inflation going forward is that monetary policy might be tighter, at least than based on what would be given by the federal funds rate. And so Choi and some other authors did a very interesting little simulation here. They built what they refer to as a proxy federal funds rate. So what this is tries to measure the three components of monetary policy: the federal funds rate, the balance sheet, and forward guidance, and collapse them into one single number, what they call the proxy federal funds rate. And so if you look over here on the chart on the right, this goes through early 2022, or about mid-2022 rather. The Fed had been raising the federal funds rate, so that's the blue line, but that their proxy federal funds rate, notice, is first substantially higher and began increasing notably earlier, right there, than the actual federal funds rate. This is when the Fed started communicating that the federal funds rate was going to increase, for example. And as a result, financial conditions, as Jerome Powell noted, began tightening even in advance of the actual increase in the federal funds rate. And so, roughly speaking, as mid-2022, the proxy federal funds rate is about twice that of the actual federal funds rate. And so what this indicates is that policy is underestimated, or the tightness of policy is underestimated based on just the federal funds rate. And so if this is true, then monetary policy is tighter than given by the federal funds rate, and this might be working to restrain inflation more than it otherwise would seem. And so let's visualize how all this sort of fits together using the aggregate demand, aggregate supply model here. So I've got there's a lot of action here, so humor me for just a little bit. And so what we want to do here is start with a baseline. So right here, for example, this might have been February 2020, just pre-pandemic. And we had an inflation rate. We're going to round up a little bit. We're going to call it 2%. It was actually a little bit lower than that, a little bit lower than the Fed's target. And there's a good chance we were in the ballpark, if not really close to, being at maximum sustainable employment. In other words, on the long-run supply curve. So at the very beginning of the pandemic, we had a very large decrease in aggregate demand as the economy closed down. And we had also a decrease in short-run aggregate supply. And so roughly speaking, this might have left us something like right here, say, for example, in the depths of the pandemic and the closures and so forth in April 2020. And so we saw a somewhat diminished inflation rate. We'll round here a little bit. We'll call it 0 just for the sake of argument. It was a little higher than that, but that's close enough. But then we saw a very dramatic bounce back post-pandemic. We saw the reopening of the economy. We saw monetary and fiscal stimulus. And so what this did is this dramatically increased aggregate demand. But the problem is that short-run aggregate supply couldn't keep up. So remember earlier we talked about that for short periods of time, the elasticity of supply is relatively low. And so that's what I've done here. I've tried to draw the short-run aggregate supply curve, the new one, somewhat more elastic, steeper sloped. Now that's not quite exactly true since I'm using a straight line here, but I think you get the idea. And so as a result, we might be something like right here in late 2022. So we have an elevated inflation rate, and we are in the ballpark. We might be at or close, so I don't want to quibble too much here, but we're certainly much closer to full employment than we were 2 years ago. And so what the Fed is trying to do is they're trying to get inflation back down to roughly the 2% target here. So what the Fed's actions are trying to do is they're trying to reduce aggregate supply, or excuse me, aggregate demand, forgive my bad handwriting, back to the original aggregate demand curve, AD0. And by forward guidance and maintaining anchored inflation expectations, they're trying to shift the short-run supply curve back to the initial short-run supply curve. In other words, they're trying to get us back to roughly February 2020, if possible, in terms of the inflation rate. This is a very difficult task. If, for example, the Fed is not sufficiently able to convince us that they're going to be able to get the inflation rate back to 2%, if they've caught us off guard, if households and firms aren't able to adjust, the decline in aggregate demand will not just reduce inflation, which of course is what the Fed wants, but it could also raise the unemployment rate. So this goes back to the discussion of the cost of lowering inflation. Is Larry Summers right, or is Chris Waller right? So that sort of remains to be seen. So some policy implications. So if inflation is mostly driven by temporary supply shocks, meaning the short-run aggregate supply curve, it's possible that monetary policymakers can wait the problem out. So if this shock is temporary and the central bank, the Fed, has credibility that it's good at keeping inflation low and stable around the 2% target there, then any increase in inflation is self-limiting. It will dissipate on its own, perhaps without any monetary policy action. But the problem arises. Suppose that the supply shocks are not relatively temporary, but they're longer lasting. Or imagine perhaps there's a relatively long-lasting demand shock. Well, then they likely need to do something in order to reduce inflation. They can't just wait it out. And this is where they come in terms of pursuing a more contractionary policy. And so they need to do this in order to reduce actual inflation, and then also to reduce inflation expectations. And so as we've noted, as recently as the early part of 2022, the Fed was still thinking that inflation might be, again, relatively transitory. So in summary here, as we saw, both supply and demand factors work to push up inflation very dramatically post-pandemic. Currently, given restrictive monetary policy, restrictive fiscal policy, improved supply chains, and so forth, it's highly unlikely, barring any, as we've noted here, any unforeseen shocks, it's highly unlikely that inflation will increase, and it's likely to fall, on the other hand, pretty dramatically in the months ahead, again, assuming that there are no other shocks. One of the main questions here is, to what extent have inflation dynamics changed? So the idea is, pre-pandemic, the Fed and other central banks had difficulty getting the inflation rate up to 2%. Will those dynamics return? Or perhaps have things shifted so that now, perhaps like the Fed of old, they need to do persistent battle with inflationary forces. So one thing, for example, that we saw that might portend this is we talked about that there's lower labor supply growth. There's also not declining growth, but actually declining productivity. So this acts effectively as a negative supply shock, which tends to work to push inflation upward. So it's unknown yet which set of dynamics is going to tend to win out, the dynamics that kept inflation low pre-pandemic, or some of the dynamics that are working to increase inflation post-pandemic. All right, thank you, everybody.